Coleman, in an earlier session, you mentioned that as your general perception of risk goes up, you want to be further up the capital structure. Can you explain what you mean by that?
Sure. Our perception of uncertainty and risk is going to lead us to choose to be more senior or secured in the capital structure or more junior. And right now the market offers a great comparison between the choices. In the high yield bond market versus the senior secured loan market to middle market operating companies. Right now you can buy high yield bonds which are junior, which are generally unsecured and pretty borrower friendly, or you can invest in senior secured loans to operating companies that has a much tighter set of restrictions, terms, and conditions that I would think of as lender friendly. But the interest rate today on those two different type of loans, one that is senior and offers security, one that is junior and offers little security, the interest rate is exactly the same. We want more of the lender-friendly type of instruments and none of the borrower-friendly type of instruments in that environment. Hence, we migrate up the capital structure.
Does that mean that senior secured is always the better option?
No, whether it's a better option or not really depends on the market circumstances that surround us. And there's a great example right now if we compare the winter and spring of 2009 with the winter of 2013. In March of 2009, the Federal Reserve Bank said it was essentially going to underwrite the value of equity and debt assets in the United States to help try to foster recovery. That was a period where one could, with reasonable risk, buy into high-yield bond assets or equity assets. Now, in 2013, we face a very different circumstance. The question is not, will the Fed continue underwriting those assets? The question is, when will they stop buying and indeed start selling those assets? What will the assets be worth when the Fed reverses course? What will the effect of a zero interest rate environment be on prices as interest rates rise? In the latter circumstance, we want to concentrate more heavily up the capital structure and senior secured. In 2009, one could venture somewhat safely into more junior instruments. So the circumstances, what the market presents to us and the surrounding circumstances really dictate where we want to be in the capital structure.
Is there some structural reason that senior secured loans to middle market operating companies should be sustainably attractive?
Well, there certainly has been a major structural change in the last 3 to 4 years that favors us as a lender. In 2005, 6, and 7, you had many sources of capital lending into that market. You had large banks, regional banks, CLOs, number of hedge funds with little or no experience in that arena entered the market. And then, of course, you had traditional lenders who were successful in that market over the last few decades. After the crash in 2008, many of the banks withdrew from that market. The CLOs have little or no capacity. Many of the hedge funds that used to lend there no longer exist. So that sector is really starved for capital today, and that makes a relatively lender-friendly environment. Some of these companies include market leaders, very conservatively financed, innovative firms that when you look at them on balance, they are oftentimes the strongest credits that you might find. The only disadvantage they have is that they're smaller in scale. But it is today, and we think will be for the next 2 years or so, an attractive market to lend into.